Hey folks, Rich here from Bravias Financial, and in this video we're going to touch on the retirement investing pitfall number 7, which is referred to as prospect theory. Now, prospect theory centers on a very interesting financial behavior, that if two equal choices are put in front of an individual, one that's presented in terms of potential gains and the other in terms of potential losses, investors are typically more focused on the potential gains versus avoiding losses. But actually, here's where things get interesting. After a loss, this typically then results in what is often referred to in loss aversion, which makes investors reluctant to sell an investment that they have a loss in until it returns to break even or better. As you can imagine, this can often be a suboptimal approach to managing investments. See, according to prospect theory, losses actually have more emotional impact than the equivalent gain. But let me give you an example of this in motion. Now, one would think the benefit gain from receiving $50 should be equal to a situation where you gained $100 but then lost $50, right? I mean, in both situations, the end result is a net gain of $50. However, despite the fact that you still ended up with $50 gain in both cases, most people view the gain of $50 more favorably than gaining $100 and then suffering a loss of $50. Now, another interesting tendency explored by prospect theory is called the sunk cost fallacy. Now, this refers to an approach that results in investors continuing to put money into a losing investment, in effect throwing good money after bad. This is even in the face of negative company or sector news. And this is on the assumption that the investment will eventually come back and at a lower cost basis due to the fact that you were adding investments as it was falling. Now, based on this theory, an investor might be better served just throwing in the towel and walking away, instead of letting their emotions get the best of them and continuing to follow a downtrend with the hopes of it turning around. Prospect theory and sunk cost fallacy can adversely affect your investment returns if you're not careful. Now, perhaps sitting down with an advisor to review your portfolio could help shed some light on what you're doing and why you're doing it, and make sure that you are carefully thinking through your decisions and not potentially sabotaging your retirement nest egg. I honestly feel like I could talk about this topic for days since I do see it often. And if you are unsure about the risk that you might be taking with your investments, like the sunk cost fallacy, why not give us a call? We'd be delighted to perform a complimentary analysis on your investment accounts to ensure that you have a disciplined approach to your retirement. Now, next week, I will keep our retirement investing pitfall series going, and I will cover pitfall number 8, which is excessive single stock risk. I'll see you then.